Matt, thank you so much for being with us here today in Deer Valley. I really appreciate your time. What do you think about valuations now, broadly, rich or cheap, and really how should investors be posturing?
So, it depends on exactly how you do the valuations, but for some time we have argued that high yield is expensive, but everything is expensive. And again, what sort of disturbed us, high yield is, and leveraged loans are probably less expensive than some other markets, but it's the way that markets everywhere have stopped responding to their own fundamentals and they're just responding to central bank liquidity. And as such, for a while, globally, we've been arguing, yes, it might look expensive, but mostly you need to buy it anyway.
So thoughts on QE. Can you give us an updated thought on where you stand now and how that school of thought has changed over time?
QE, as we see it, is the single factor that correlates best with spread movements, especially actually in high yield, and has replaced some of those fundamental relationships. QE does seem by and large to work globally. So there was this big debate as the Fed tapers, can ECB and BOJ liquidity replace it? And we think the answer, at least up till now, has been yes. But equally, QE is sort of large and slow moving, whereas rate hikes can have a much more immediate effect on the demand side. QE affects the supply side by reducing the number of assets that investors have available. And as such, while that has held to date, the Fed is tremendously important, and if the Fed is too hawkish, there's the risk that investors will leave the asset class and go back into cash. For now, we don't think that has happened or will happen, but it's quite finely balanced.
So with that, what are you kind of proposing right now for investors? Are you still an advocate of kind of the barbell approach for their portfolios? Is that something that you're still talking a lot about in your research?
So pretty much yes. In general, for us, it's an environment where we're not particularly bullish on the economy, but we do see markets doing well. And as such, effectively, it's a question of positioning for bubbles and bubbles getting bigger. One of the easiest ways of doing that within credit is moving down in quality. And again, that's something we're not necessarily getting longer, but moving down in quality because high yield companies are leveraging up less than investment grade companies. The supply picture in high yield is better than it is on the investment grade side. And because investors are reaching for yield and investment grade is so much larger that even a small amount reallocating can have quite a large effect on prices. At the same time, though, for fear of outflows or fear that it turns into a bubble, a barbell is one way of, we call it finding a cheap way of getting long convexity, making money if the market keeps on squeezing tighter, but also having some degree of protection if it doesn't.
Okay, so when we think about outside risks, and particularly Greece, what are your thoughts on how that's going to play out? How do you think it's affecting the markets, and how should investors be managing their portfolios in the context of expectations around Greece?
The interesting thing is how little anyone has asked us about it until literally this week. Okay. And I think that's because there is a widespread presumption that it will all get resolved at the last minute. And too many times people have sold early and then regretted it later. And of course that is looking more and more questionable, although there is still some chance of a positive resolution. What we're becoming steadily more worried about is an environment where Greece defaults but doesn't necessarily leave the Eurozone, at least not immediately. And under that circumstance, we're worried it starts to look like a good example for Podemos in Spain and the Five-Star Movement in Italy. And it's relatively difficult to see what sanctions the rest of the EU could put upon them beyond the immediate curtailment of ELA and kind of structural funds. Just how much immediate contagion should that cause? That's hard to say because directly, not very much. The banking system is much less exposed. Yes, a few hedge funds have positions, but the immediate consequences are not as great as all that. But the nasty scenario for us would be in this environment where investors are long lots of assets generally that they don't really believe in this environment where we're vulnerable to fund outflows, that Greece plus a hawkish Fed plus negative year-to-date returns on the yield back up and the Bund volatility start to cause fund outflows, and Greece at that point could turn into just one more catalyst putting pressure on the market. And so it is a reason why we dropped down to neutral certainly on the investment grade side in Europe a few weeks ago now. And until that is resolved, there's still the risk it can put pressure on markets. But our guess is that the real significance is longer term rather than immediate.
And in your mind, as we stand today, what is kind of the single biggest risk facing the broad credit markets today? Is it interest rates? Is it credit quality? Is it liquidity? If you kind of had to define, one of the biggest things that you're most concerned about.
The biggest problem is that everyone is the same way around. We have all crowded into the same positions that we don't believe in on fundamental grounds because we think there's more money coming in afterwards, driven by the central banks. And this creates the pockets of illiquidity that we've started to see. It's not just dealers having less balance sheet, it's herding on the part of investors. And yes, this does give us way more especially way more sensitivity to the central banks trying to withdraw than you would have thought. But also, as we saw in bonds, it leaves us vulnerable to sudden corrections even without an obvious catalyst. And so it's that lack of conviction that investors have and the associated vulnerability to things like outflows, which, again, it's not our base case scenario, but I do think it's a very significant risk.
Well, thank you so much, Matt. I really appreciate your time today.